Ever wonder if the housing market is leaning towards sellers or buyers?
Yeah.
Especially in a place like Austin. It's seen some pretty wild swings.
Absolutely wild.
Well, as of early July 2025, the picture seems to be getting, let's say, much clearer. Welcome to the Deep Dive.
Glad to be diving in.
Today, we're really digging into the Austin real estate scene. We're pulling key insights from the latest market briefings, online analysis, all that good stuff.
Yeah, cutting through the noise.
Exactly. Our mission, give you the unvarnished truth, help you understand the why behind the numbers, and maybe figure out the what now.
Yeah.
For anyone interested in this market.
And it really sounds like a significant shift is underway.
It does. So if someone's listening, what's the single biggest takeaway from the data we're about to unpack?
Well, I'd say the data clearly points to a deepening correction, and there's a very clear buyer advantage now.
That buyer advantage, okay.
Yeah, and what really stands out, I think, is that these aren't just small shifts. These are, the hallmarks, the signs that leverage has fully, completely transitioned to buyers.
Right, because for a long time, sellers held all the cards.
They really did. But the numbers we're looking at today, that story has definitely changed dramatically.
Okay, let's unpack that then.
Yeah.
Starting with supply. Because, to understand power, you got to look at what's actually for sale.
Makes sense. Supply first.
All right, now, active residential listings.
Yeah.
Let me see. It's about 17,700 properties. Almost.
17,679 to be precise.
There you go. And that's only a tiny bit lower than the record high, which was over 18,000 just, a few days ago? End of June?
Yeah, June 27th hit 18,076. So we're basically still at historic highs for inventory.
Which just means inventory is still historically high. A huge change from when homes were just vanishing in days.
Oh, completely different world. Buyers actually have time to breathe now.
And sellers. They must be feeling the pressure to compete like never before.
And you see that directly reflected in the prices. It's actually staggering. Nearly 60%, 56.9% to be exact, of all active listings in the MLS have had at least one price drop.
Wait, almost 60%.
60%. Yeah, this isn't just a few homes here and there. It's widespread.
That's huge.
Yeah.
So what's that telling us about seller psychology right now? I mean, how long can that go on?
Well, it directly reflects, deep seller concessions. Supply is just significantly outpacing demand.
But it's not everywhere, right? You mentioned some exceptions.
It's true. It's not uniform. You've got places like Jarrell actually seeing price increases on about almost 15% of listings. Manor around 12%. So it's dynamic.
Interesting. So pockets of strength still exist.
Definitely. But the overall trend is clear, and it's not slowing down. Look at new listings. January to June this year, over 29,500 new homes hit the market.
Wow.
That's up 7.1% from last year, and get this, 31% above the 25-year average. It's a flood, not a trickle.
Okay, so that supply picture is overwhelming. But what happens when you combine that with buyers pulling back? Let's talk demand.
Exactly. That's the other side of the coin. We need to decode buyer activity, the market pace. Let's look at the activity index, the AI.
Right, the AI. Explain that quickly.
Think of it like the market's pulse, a gauge of buyer demand. Right now, it's sitting at 19.4%.
19.4. How does that compare?
Well, that's a sharp drop. It's down 15.4% just from last year when it was around 22.9%.
And historically?
During the boom.
Oh, historically, in peak years, Austin's AI was well into the 30s, even 40s. So 19.4%. That signals a pretty significant cooling.
So buyer demand has definitely pulled back. And just like inventory, I bet we see variations between cities here too.
You bet. Hutto, for example, is up around 31.7%. More activity there.
Okay.
But then you look at Smithville, and it's way down at 6.9%. Just shows how fragmented things are.
That fragmentation is key. Okay, what about pending listings? Homes actually going under contract.
Right. So pending listings, cumulative Jan to June, nearly 23,000. Now, that's actually still a bit above the long-term average.
Oh, really?
Yeah, about 4.5% above. But, and this is the crucial part, it's down 5.6% from last year.
Ah, okay. So the year-over-year trend is down, even if it's above the long-term average. Exactly. And the net effect, a widening supply-demand gap. We had about 6,600 more new listings than pending sales in that period.
6,600 more homes listed than sold. What does that gap really mean for how quickly homes are actually moving off the market?
Well, that brings us to absorption. How quickly is the market soaking up these new listings? We look at the new listing to pending ratio for that.
Okay.
It basically compares new supply to what's going under contract. Year to date, that ratio is 0.67.
0.67.
And the average?
The 25-year average is 0.81, so we're well below that. The monthly figure is similar, 0.66.
So sustained underabsorption. Homes are coming on faster than they're selling relative to history.
Precisely. It reinforces that narrative.
And for anyone listening, buyer or just curious, the months of inventory, the MOI, that's a big one, right? Tells you how long it would take to sell everything currently listed.
Absolutely. Key metric. And currently, it's 6.28 months.
6.28. How does that compare? That's up significantly, over 18% from last July's 5.32 months. And year to date, MOI is up almost 29% compared to 2024.
So what's the takeaway for, the average person?
Well, the long-term equilibrium, a balanced market, is usually around 4 to 5 months of inventory.
And we're at over 6.
Exactly. 6.28 months firmly places Austin in clear buyer's market territory. If you're buying, you have options, significant options.
And I bet we see a huge range there, too, by city.
Oh, absolutely. Hutto's down at just under 3 months, so it's moving faster. But then you have Marble Falls and Dale both at 11 months.
11 months? Wow.
Yeah. And Smithville, again, saw a huge jump, over 75% year-over-year increase in its MOI. It really drives home how hyperlocal real estate is.
Okay, so inventory's high, buyers are stepping back. The inevitable result has to be prices, right? Let's get into the price correction. Where do values actually stand now?
Right. The bottom line for many. So sales volume first. June saw about 2,776 sales. Year to date, almost 15,000.
15,000. How's that tracking?
It's actually down 6.2% year over year.
Okay, down.
What? Here's the counterintuitive bit. It's still 8.4% above the long-term average for sales volume.
Huh. So fewer sales than last year, but still more than the historical average. How does that work?
It's a bit nuanced. While the raw number looks okay against the long term, when you dig deeper, you see stress. If you adjust for population growth and the sheer number of real estate agents now.
Per capita or per agent?
Exactly. Sold properties per 100,000 residents, nearly 20% below average, and per 1,000 realtors, down over 24% from historical norms.
Okay, that paints a different picture. Intense competition for fewer deals per agent.
Brutal competition. It's a clear sign of an oversupplied market impacting the folks in the industry.
And the numbers everyone waits for.
Yeah.
The actual prices. The average sold price.
Average sold price is currently $587,763.
Okay. And how far down is that from the peak?
That's a 13.81% decline. Almost $95,000 drop from that May 2022 peak of $681,939.
Nearly $100,000 off the average peak price.
Yeah.
Wow. And the median.
Yeah.
It's often a better indicator, right?
It often is, less skewed by high-end sales. The median sold price is now $445,000.
$445. And the drop there.
Even sharper. That's down 19.09%, a $105,000 drop from its peak of $550,000, also back in May 2022.
Over 19% drop in the median. Ouch. What does that mean for homeowners, especially recent ones?
Yeah, this raises a really important point. If you compare the current median price to where it was 36 months ago.
So mid-2022-ish.
Right around the peak or just before. The differential is negative 16.82%.
16.8% negative.
Which means, plain and simple, many people who bought near that 2021-2022 peak are likely underwater now. Significantly underwater, especially when you factor in inflation.
Imagine buying then and seeing your equity just evaporate.
It's a tough reality for many, and it underscores that this isn't just a blip. It feels like a structural correction.
Okay, if it is structural, what does that mean for recovery? Getting back to those peak prices.
Yeah.
When could that happen?
Well, first, let's remember Austin's long-term appreciation. Over 25 years, it's compounded at about 4.9%, almost 5% per year.
Okay, decent long-term growth, historically.
Right. So if we make an assumption, a big if, that the current median of $435,000 is the bottom.
If this is the floor.
Then, based on that historical appreciation rate, the projection suggests it would take about 55 months to get back to the previous peak median price of around $550,000.
55 months. That's over 4.5 years.
It translates roughly to a projected recovery date sometime around December 2029.
2029, wow.
Yeah. And that timeline, I think, really underscores the structural nature we talked about. It kind of dispels any notion this is a quick, short-term rebound.
What do you mean exactly by structural correction in this context?
It means fundamental things have shifted. Think interest rates, finding a new normal. Maybe migration patterns slowing down compared to the frenzy, investment cycles changing. It's not just a little dip we bounce back from quickly. It suggests a longer rebalancing act over several years.
And this correction, it's not hitting everywhere equally, right? You mentioned bifurcation earlier.
Exactly. If you segment the market by price, looking at the bottom 25th percentile, the more affordable homes.
Yeah.
They saw about a 5.5% price decline year over year. But the top 25th percentile, the luxury end, a much, much more modest drop, only about 0.4%, almost flat.
Interesting. So the lower end is feeling the pain more acutely. Why do you think that is?
It could be several things. Maybe higher-end buyers are less sensitive to interest rates. Maybe there's just tighter supply in the luxury market. Or perhaps first-time buyers, often in that lower bracket, are more impacted by affordability challenges.
Makes sense. And the city-level differences reinforce this patchwork idea.
Absolutely. We track about 30 cities in the Austin area. 13 of them actually saw positive year-over-year median price appreciation.
13 up, so 17 down.
Right. And the range is huge. Driftwood, for example, saw over 21% appreciation year over year.
21% up?
Yep. But then Wimberley is down 9.5% year over year. So you absolutely have to look at the specific micromarket you're interested in. It's not one single Austin market anymore.
Such a fragmented picture. Okay, to sort of wrap this all up and confirm the main theme, you mentioned a couple of overall indices.
Yeah, two final ones that give a good composite view. First, the Market Health Index, or MHI.
MHI. What's that measure?
It combines velocity, absorption, inventory, basically an overall health score for the market. The current MHI is just 17.60%.
17.6. And what's the benchmark there?
Well, generally, anything below 30% indicates a definitive buyer's market.
Oh, we are well below 30.
Way below. The historical average MHI is around 30.9%, so 17.6%. We're deep in buyer's territory.
And the second index?
The Inventory Stress Index, or ISI. This one quantifies how much pressure pending sales are putting on the existing inventory, factoring in supply-demand changes.
How stressed is the inventory?
Not very stressed. From a seller's perspective, the current ISI is 5.02%.
5%. And the threshold there?
Readings below 10% usually indicate inventory levels that strongly favor buyers.
Again, well below the threshold.
Right. The historical average ISI is 12.56%. So both indices, the MHI and the ISI, they really just cement that buyer advantage narrative. Conditions are highly favorable for buyers right now.
And conversely, increasingly challenging for sellers, especially, as you said, those who brought near the peak.
Absolutely. So in sum, what really stands out is that the Austin market seems pretty entrenched in this broad correction cycle.
Elevated inventory, demand is soft, significant price drops, sales efficiency weakening.
That's the picture across the board.
Okay. So for you listening, whether you're a buyer looking at opportunities or maybe a seller trying to navigate this, the key takeaway seems pretty clear. You really need a long-term view, right? And rely on the data.
A long-term, data-driven perspective is essential right now.
So here's a final thought to leave people with.
Okay.
If the market is in this broad correction, this structural rebalancing, maybe getting back to that absolute peak value isn't the only way to think about recovery.
That's an interesting point. What else matters?
Right. What does this whole rebalancing mean for the future character of Austin's housing market beyond just the price tags? And maybe how should you adapt your own strategy in this landscape that's clearly still evolving? Something to think about.